In this video, I'm going to review the performance of Albert E Sharp's model portfolios for April and to reflect back on the first quarter of 2020. I'll take a closer look at some of the funds that we hold, examine the underlying holdings, and touch on any possible changes. After an extremely difficult period, you'll see that we've actually fared much better than the majority of our competitors, particularly in portfolios where equities feature. And in this video, I'm going to explain why that's the case, what it is that we do differently here at Albert E Sharp, and why we expect this outperformance to continue. My name's James Crocker. I'm a partner here at Albert E Sharp. My main responsibility is the construction and management of the risk-rated model portfolios that we run for financial advisors across the UK. We have a track record now that dates back to 2012, and our investment philosophy and process, I believe, is very distinct. It's very different from the majority of our competitors, but more on this later. Today, I will be specifically talking about the core models that we run for advisors on the various platforms such as Standard Life, Transact, Aviva, Zurich, True Potential, and many others. Our portfolios are very simply named on a numerical basis from 1 to 10, with 10 being the riskiest. We think that's the easiest way to communicate the risk level. Because cautious, because balanced, because growth can mean different things to different people. And in volatile markets, the outcomes, as we know, can be very different. Now, it goes without saying that this has been an extraordinary period to be reflecting on. Back in January, looking forward into the new decade, it's fair to say we were probably a bit more optimistic than the others. We made a few changes early on across the board, across the portfolios. One was to finally eliminate UK equity trackers forever, and also to increase our US equity exposure. Fast forward a matter of weeks and all of a sudden the world is in a completely different place. Right now, on the 21st of May, the UK all share is still down by almost 20% year to date, having been down 35% at one stage, with a lot of funds in the mid and small cap space down over 40% or more at one stage. The US was down over 20%, but it's recovered strongly, and with the dollar strengthening, it's now flat for the year in sterling terms. The tech-heavy Nasdaq Composite Index is now up almost 14%. That's in sterling terms, of course. So there are clearly shades of grey in this so-called crash that we've seen over the last few months. And in fixed income, we saw some incredible volatility. In the 10 days running up to the low on around about the 19th of March, the index-linked gilts index had fallen about 17% at one stage, which is an enormous amount. High yield junk bonds created over 20%, credit spreads blew out, and at this point there was palpable panic. But a lot of these losses have been erased, but not everywhere. In fact, it seemed not so long ago that the speed of the sell-off would prove to be one of the hallmarks of this episode, but right now in May, the bounce back is possibly just as much a feature. So let's take a dashboard view of the performance of our models for April 2020. The first thing to say here is that these numbers assume our management fees, which is 0.6 per annum, including VAT. It takes into no account for platform fees or advisor fees, and it assumes zero dealing fees, which is usually the case, certainly for open-ended funds. So as you might expect, this was a positive month across the board, certainly our strongest since we started these models, as I said, back in January 2012. Now, in order to provide a benchmark, we use data provided by Asset Risk Consultants, otherwise known as ARC. Each month, they take in portfolio return data from the vast majority of the DFMs across the UK. They then separate out the results based on risk, and then they provide us with return data that fall under 4 key benchmarks. So we're comparing our model portfolio returns against actual performance of our competitors. So starting at the top of the table, we see the ARC Equity Risk Index. As the name implies, this is for portfolios that are the riskiest, with most exposure to equities to global stock markets. And we can see that the average portfolio from all of the contributing companies returned 6.9% over the period. Now we've got 3 portfolios that fall under this category, 7, 8 and 10. And as you can see, they're all comfortably ahead in April, with our Model 10 up by double digits over the period. Now as we go down the risk spectrum, our Model 6 was up 7.9%, which was nicely ahead of the steady growth benchmark, which was up 5.6%, as were our 2 balanced models and our cautious models too. Much of the return comes from our US holdings. Our US microcap fund was up a whopping 23% over the period. Global small cap was also up well over 20%, which for a single month really is an enormous amount. Over the period, currency has certainly helped us, and by that I mostly mean the US dollar. We tend to have a much higher level of exposure to international markets relative to our peers. The dollar really matters. In our Model 5 portfolio, we have 58% in equities, and of that 13% is in the UK, therefore 45% is international. Unless we hedge, and sometimes we do, a weak sterling is usually good news for the portfolio from a translation point of view. And at present, sterling is down almost 8% year to date.